Welcome back. Today, the Philadelphia Federal Index or Philly Fed Survey was released. It's a regional Federal Reserve Bank index measuring the business growth, specifically in the Philadelphia, New Jersey, I believe Delaware area as well. It's also called the Manufacturing Business Outlook Survey. The Philly Fed Manufacturing Index is in positive territory for the first time since May of 22. If you recall, we just spoke about the New York Empire State Manufacturing Index, which was in negative territory for the first time. So it's interesting to see back-to-back manufacturing surveys that are kind of contradictory. Blue line here is the S&P 500. The red line is the overall activity. This is the headline number that we usually read. It's in positive territory again for the first time in several months, reading a level of 12. Now, it's a survey. It's made up of many different factors within the survey, and it's broken down specifically by within the industry, sub industries or sub components of that industry, which we're going to take a look at in just a moment. Notice overall, generally speaking, there's a positive correlation. We see on the left hand side of the chart, 2017. This survey hits highs near 40 at the time the S&P 500 was moving higher. Now, I think the way to look at this is to see that when we have consecutive months in positive territory, especially the 20, 30, 40 area, you generally tend to see strong stock market patterns. You're not going to see the line go up at the same slope, but we want to see consistent activity in the positive territory, and that coincides with strong markets moving to the upside. Obviously, a huge turn down early 2020 as a result of the COVID crisis. But then we see a huge stock market recovery. Again, Philly Fed survey between 20, 30, 40 area. Then we dip down, which coincides with the stock market sell off that we saw going into the end of last year. That's when the Philly Fed survey was below 20 and at some time actually negative territory. Well, we're back above negative territory. We're only at 12. Again, we really want to see levels near 20, 30, or 40 to see superior stock market performance. It kind of looks like a lot of the other charts we've seen lately, where the stock market seems to be running ahead a lot of these economic numbers. This is this month's actual report. The general activity, that's the headline number, that comes out at 12. Then we have the sub-components of the Philly Fed survey. There's actually a lot more. These are the 10 major components. We have Philly Fed current inventories, negative 10.2. Unfilled orders, negative 4.8. Work hours is 6.3. Shipments, 5.7. New orders is positive 16. Employment, negative 6. Prices paid, positive almost 21. Delivery time -7 and positive 14.1 for the prices received. Now, I'm sure that manufacturing analysts and experts in this field can dive into the intrinsic differences within the subcomponents of this industry. I don't know if we're at that level here. I think it's important to recognize that when most of the components are either in positive or negative territory, and to what extent it looks like on the surface most of the survey is in positive territory, and I think that's a good thing. If we really want to dive into this, maybe we can analyze, well, here's the issue. But overall, I'd want to see most of these bars in positive territory, which we do see. Notice in particular prices received. We're going to talk about this in a second. This seems to be a very volatile component of this survey. Now, this is going back to January of 2021. These are those 10 subcomponents of the Philly Fed survey. The line at the top is our prices paid. Prices received is the purple line. Now, prices paid seems to be a very volatile, also prices received seems to be a very volatile component. We can see that when this Philly Fed survey was quite strong, notice how strong the prices paid numbers were. Positive 80 territory at one point. We saw the inventories really drop down, but then again, we've read a lot about, the backlog and the logistic problems that we had in terms of inventories. Maybe manufacturing analysts, would point out the same thing. Notice how most of the lines seem to be trending lower. Now, it does look like we bottomed out the beginning of this year, the end of last year, and we look like we're going back into positive territory. But again, the strongest sector here is prices paid, and that's only at the 20 level. We know what a strong manufacturing sector looks like, and that's when these lines are 30, 40, and even a lot higher than that. Now, compare and contrast that to the years of 2007 through 2011. Now, we're not again alluding to the fact that I think we're going to repeat the cycle of 2007, 8, etc. But it is a remarkable period of time within economics and, financial markets. So I think it's interesting to see the extremes that these economic reports achieved. Notice 2008, mid 2008, when the stock market was chugging along, the prices paid, again, this seems to be the most volatile components of this index, was again near 80, kind of like where we were just a little while ago, last year or so. Prices paid. Then we had that downturn, and look at all of these lines coincided in the negative 40 territory. That was late '08, early 2009, really at the bottom of the stock market. The March of 2009 was the bottom of the S&P 500 and the Dow Jones Industrial Average. And then as we turn back to the upside, take a look at again, what index seems to be leading the way higher? Prices paid. Something special about that. Maybe this is most closely linked to inflationary pressures. Just a guess. But that would make sense. And again, compare and contrast that to where we are now. Again, of course, this is prices paid on top, followed by prices received. The orange line is employment, and that seems to be in line with most of the other numbers as well. So again, if we are an optimist, if we think that stocks are going to continue higher, maybe it's a case of buying the rumor, selling the news, and the stocks are moving ahead of what the manufacturing sector seems to believe. It's going to be a strong quarter or strong year. Maybe we'd see these lines move up. It just seems, though, that the stock market seems to be running way hotter than a lot of these economic numbers. Now, this is interesting. This compares our 10 sectors of the Philly Fed survey to the S&P 500, and we went back 100 months. So we went back several years trying to find the strongest correlation, meaning that sector within the Philly Fed survey that seems to move closest to the S&P 500. Well, when we have a positive correlation of 100%, it's a one-for-one relationship. When one index goes up 1 point, the other index also goes up exactly 1 point. If you have a negative 100% correlation, it means they're moving in exactly opposite directions. One index goes up 1 point, the other goes down equally -1. A zero correlation means no relationship. One index moves and the other is not affected. Notice the two sectors that seem to have the strongest correlation to the S&P 500. Prices paid, prices received. These two sectors in particular seem to have the strongest correlation to the stock market, specifically the S&P 500. Well, here's prices received in red, S&P 500 in blue, and we see why there's such a strong correlation. From hitting those lows of early March 2020, we see stock market travels higher and hits a very significant high almost exactly around the same time as the S&P 500, I should say S&P 500 and prices received, right around the same period of time, early 2022. What's curious, and go back even further, go back to 2015 before we knew any of this was going to happen. Take a look at how the two lines seem to be moving in very, very close proximity to each other in terms of their angle of ascent. What's really interesting, though, is again, June of 22. And for those of you that have been with us for a little while, you know why June of 2022 is important. It's the beginning of the inverted bond yield condition that we've spoken so much about because it is very, very significant. At that point, the S&P 500 takes off to the upside, and the index, like many, many other indices that we've spoken about, moves to the downside. If prices received, now I know it's strong, it's in positive territory compared to where we were a few months ago, but certainly this correlation seems to have fallen apart. It's an area of great concern for stock investors. Does it mean that the stock market is overbought? Does it mean it's too expensive? Or does it mean that all of these macroeconomic numbers just haven't caught up. They haven't seen what the stock market sees. Is the stock market moving up as a result of inflationary pressures? Well, we can't say low interest rates. Those aren't around anymore. What do you think? It really is the dilemma we see within macroeconomics these days, the huge divergence between stocks and economics. We can dive into the actual numbers. These are the 10 subsectors within the Philly Fed, and we can see the general activity. That's this month's report, 12. Inventory is negative 10, negative 4.8, etc. Prices paid is up 21. Prices received is up 14. And we can see here, generally speaking, if we were to average these numbers, we'd be in positive territory, but not by a great extent. Certainly better than we were in March or February of this year, but certainly just barely above positive territory. Now, compare and contrast. I just, kind of take this image and keep in the back of your mind. Compare this now to where we were 2007. Let's take a look at, December '07. We see the general activity index was negative 5.4. Actually, well, now the general index currently is 12. Well, November of '07 it was 6.6, before that 7.8. And we can see the prices paid. That was around the 40 level, which is more or less where we are now. Prices received also in that territory. So the numbers, if we tried to match this up, it looks like we'd be pretty close on average to where we were sitting late 2007. Notice what happened mid '08. The general activity number dipped negative, negative 16, 17, etc. Prices paid was actually even stronger. Maybe we still saw a lot of inflationary pressures at this point. But notice how fast late '08 the things really turned sour. And when the general index hit that low of negative 39 in February of 2009, right as the stock market was hitting lows, the prices paid hit a negative 15, then 34, then negative 36, and then back to the races. We really want to watch the prices paid, prices received sub indices within the survey. They seem to really be very reactionary to conditions, and perhaps that could be our leading indicator. So that's where we stood 2009, 2008, 2009. And again, this is where we are now. Prices paid back up to, I stand corrected, not 40, a 20 level, 21. Prices received 14.1. The general activity, I'd run at 12 level. So it looks like we've dipped back into positive territory. The trend, at least for the past few months, is in an upward direction. Although I would not say that this is stellar. Again, this is the general activity index. It's a good summary of the survey, the Philly Fed survey. It's positive. It's encouraging that we're back in positive territory. Is this beginning of a trend? One economic number certainly is not a trend. It's a nice change. But on the back of the New York Empire Manufacturing Survey we just spoke about, which was not that good, we like to see this better. And it definitely, in my opinion, is not as strong as what stocks would lead us to believe. So there's a lot to watch, and we certainly have a lot more on the economic calendar to look forward to as well. We hope this has been helpful. We look forward to seeing you back soon.